what is an indirect method of testing in a sales tax audit? So in a prior video, we talked about what the direct method of testing is. Direct method of testing involves testing actual source documents, lining up and comparing them. When you have a breakdown in the direct method, then sales tax auditors will resort to what they call indirect methods of testing. Indirect methods of testing is a fancy way of saying we're going to play guessing games with statistics. So one of the indirect methods of testing is to audit past sales. They'll look at current sales and they'll do statistical comparisons between past sales and current sales. So one of the easiest ones they do is they do an observation test. They'll send an auditor in a business for a couple of days to look at the sales that are being performed, whether the employees are ringing everything up correctly, whether they're charging tax, and then the auditor will sit there and literally record every single transaction, and they'll compare that against the POS system reports to see if there are any discrepancies. And then that's called an observation test. So if there's an error within that test, then they'll do certain things based on that error. The other thing they can do is they can take the POS system reports in a current period and do a cash to credit card ratio. So a lot of the times they'll take your credit card ratio, which can be verified by your 1099Ks, and they'll say, okay, here's the percentage of credit card sales based on current, here's the amount of cash sales, and we're just going to project that across the quarter. So the problem that we see with indirect methods of testing, let's take the cash to credit card ratio for example. Auditor comes in and says, I'm going to do 2 days of testing in a business. I'm going to do a restaurant. And I'm going to come in Tuesday at lunchtime, and I'm going to come in Sunday afternoon. So what the auditor is saying is, based on 2 days of testing, that 2 days of testing is going to be used for a sample, because they're taking 2 days. So they're going to take that sample and they're going to apply it to a population being a total data set. They're going to take a 2-day sample and they're going to apply it to a 3-year period of a population. So the 3-year population is over 1,000 days. They're going to take 2 days of sales and they're going to say these 2 days of sales, Tuesday at lunchtime, Sunday afternoon, are representative of this entire 1,000 days of sales. Hopefully you can see the problems with that. Some businesses do more credit card sales on the weekends. Some businesses are seasonal and will do sales more frequently at certain times and more frequently at others. With restaurants, you have families going out on Saturday nights for dinner. Those tend to be larger checks, and so you tend to pay larger checks on credit cards unless you're walking around with a fistful of cash. So depending on little things, and this is why indirect methods of testing are so dangerous, little hinges swing big doors. So these little statistical changes can make a huge result as to the liability. They can have massive impacts. I mean, we've seen situations in the firm. We have a client that the CDTFA came in and they said, look, we think that your client has underreported $3 million in cash sales. And just sat there and looked at the agent. I said, if you really think they underreported $3 million in cash sales, where's all the cash? They didn't deposit $3 million in cash in the bank. So what you're telling me is they went home, they stacked the money under their mattress, they got $3 million in cash sitting there in this giant brick under their mattress, and they've just been hoarding it. And or they've been going around and spending all this cash all these years, which is not supported by any basis in reality. And if you actually thought they were underreporting $3 million in cash, you would have sent the guys with the windbreakers and the handcuffs and the flak jackets after them. Criminal people. So that's why indirect methods are so dangerous. And I use that as an absurd example because it was an absurd example, but that's what happens when you have these statistical things. So you need to be very, very careful with indirect methods of testing. And one of the reasons I advocate for, if you're going to have somebody represent you in a sales tax audit, they've got to know about statistics, is because of these situations. We find so many statistical errors. These auditors aren't statisticians. So We find so many errors in the way that they're doing their statistical analysis, the tightness of their controls, their procedures, the way they're applying samples to populations. I mean, it's just a mess. So that's the way that indirect methods of testing work, and that's frankly why they're so dangerous. So whenever possible, you want to avoid indirect methods of testing and focus on direct methods of testing, because direct methods of testing are much more reliable than their indirect brethren.